There's a quiet assumption most people never question until it's too late that the money sitting in their bank account is unquestionably safe, untouched, and fully theirs no matter what happens next. But if you've spent enough time watching how financial systems actually behave under stress, you start to see the cracks long before they become headlines. The real risk isn't the obvious one, it's not the market volatility everyone obsesses over, it's the hidden fragility inside the banking system itself, where confidence is the only thing holding everything together. And when that confidence starts to slip even slightly, the question stops being how much you've earned and becomes how much you can actually access when it matters most. What most people call a bank is, in reality, a finely balanced system built on confidence rather than certainty, a structure that gives the appearance of stability while quietly operating on a fraction of the cash it promises to safeguard. When you deposit money, it doesn't sit in a vault waiting patiently for your return. It is immediately put to work, loaned out, invested, and circulated through the broader economy. This is the foundation of modern banking, a system designed to maximize efficiency and growth, but one that inherently depends on the assumption that not everyone will ask for their money back at the same time. That assumption holds right up until the moment it doesn't. The illusion is powerful because it's reinforced every day. You check your balance, and the number is there. You transfer funds, swipe your card, pay your bills, and everything functions seamlessly. There's no visible friction, no sign of strain, nothing to suggest that beneath the surface, the system is operating with limited reserves. In fact, most banks keep only a small percentage of deposits readily available, relying on the predictability of customer behavior to maintain equilibrium. It's a model that works incredibly well in calm conditions, which is precisely why it's rarely questioned. But the structure reveals its true nature under pressure. When uncertainty begins to rise, even subtly, behavior changes. People become cautious, then concerned, then reactive. Withdrawals increase, liquidity tightens, and what was once a stable flow turns into a stress point. The system doesn't break all at once. It starts with small shifts that compound quickly. A few large withdrawals here, a tightening of credit there, and suddenly the margin for error begins to shrink. Banks are then forced into defensive positions, raising capital, selling assets, or seeking external support, all of which signal to the market that something is wrong. And that signal is often enough, because once doubt enters the system, it feeds on itself. Depositors don't wait for confirmation, they act on perception. The logic is simple and brutally rational. If there's even a chance that access to funds could be restricted, the safest move is to withdraw first and ask questions later. This is how trust, the very foundation of banking, can erode with surprising speed. It's not about whether a bank is fundamentally solvent in the long term. It's about whether it can meet short-term demands in real time. What makes this dynamic particularly unsettling is how invisible it is during normal periods. There are no alarms, no warnings built into everyday banking experiences. The system is designed to appear solid, and for the most part it is, but that solidity is conditional. It depends on behavior remaining within expected patterns. The moment those patterns shift, even slightly, the underlying mechanics become exposed, and once exposed, they're difficult to ignore. This is where the concept of safe begins to lose its clarity. Safety, in a banking context, is not absolute. It's a function of stability, confidence, and timing. Your money is accessible as long as the system is functioning smoothly and others are not simultaneously demanding their share. The number in your account represents a claim, not a guarantee of immediate liquidity under all conditions. That distinction is subtle, but it becomes critical during periods of stress. Even regulatory frameworks and safeguards, while important, operate within the same constraints. They can provide reassurance, slow down panic, and offer a backstop, but they don't eliminate the core structure of fractional reserves. They don't change the fact that the system is built on distribution rather than storage. And they certainly don't prevent behavioral shifts when uncertainty rises. For those who understand this, the perspective changes. It's no longer about blind trust or outright fear, but about recognizing how the system actually functions. It's about understanding that stability is maintained through balance, not permanence, and that confidence is both the system's greatest strength and its most fragile component. And once you see how much of the system depends on balance and behavior, the next realization becomes harder to ignore that liquidity, the very thing people assume is always there, can vanish far more quickly than anyone expects. It doesn't erode slowly in a predictable, linear way. It disappears in bursts, in sharp shifts, in moments where access goes from effortless to uncertain almost overnight. And by the time it becomes visible to the average person, the process is already well underway. Liquidity is often misunderstood because it feels constant every day. Money moves seamlessly through digital channels, creating the impression that cash is always available, always flowing, always within reach. But that flow is conditional. It relies on a network of obligations being met, assets maintaining their value, and institutions trusting one another enough to keep capital circulating. When that trust begins to weaken, even slightly, the flow starts to slow. And when it slows, pressure builds in places most people never think to look. Banks don't just rely on deposits. They rely on access to short-term funding, interbank lending, and the ability to convert assets into cash when needed. Under normal conditions, this process is routine. Assets can be sold, loans can be securitized, and liquidity can be sourced quickly. But in times of stress, the market for those assets can tighten or even freeze. What was once considered liquid becomes difficult to sell without significant loss, and that loss creates hesitation. Institutions pull back not because they want to, but because they have to protect their own positions. This is where the shift accelerates. As liquidity becomes less available, banks grow more cautious. Lending slows, credit lines are reduced, and internal thresholds become stricter. These changes don't happen in isolation, they ripple outward. Businesses that rely on credit begin to feel the strain. Individuals who were once approved easily now face delays or rejections. The system starts to contract, not dramatically at first, but enough to change behavior. And behavior, as always, is what drives the next phase. Because once people sense that access is tightening, they adjust, they hold on to cash longer, delay investments, and in some cases, begin withdrawing funds preemptively. Not out of panic, but out of caution, and that caution, multiplied across thousands or millions of participants, becomes a force of its own. It reinforces the very conditions that created it. Liquidity tightens further, not because of a single event, but because of a collective shift in mindset. What makes this particularly dangerous is the speed at which it can unfold. In a world where transactions are digital and information spreads instantly, the feedback loop is compressed. News travels fast, reactions are immediate, and decisions that once took days now happen in minutes. A rumor, a report, or even a subtle change in tone from a financial institution can trigger a wave of activity. And once that wave begins, it's difficult to contain. There's also an asymmetry to liquidity that most people overlook. It's abundant when you don't need it and scarce when you do. During stable periods, capital is easy to access, terms are favorable, and the system feels generous. But under stress, those conditions reverse. Access becomes selective, terms tighten, and the same institutions that once extended credit freely begin to pull back. It's not a contradiction. It's the natural response of a system trying to preserve itself. This is why the idea of always having access to your money is more fragile than it appears. It's not just about whether the funds exist on paper. It's about whether they can be mobilized in real time without disruption. And that depends on layers of liquidity functioning simultaneously, from the individual bank to the broader financial network. If any of those layers seize up, even temporarily, the impact can be immediate. Understanding this doesn't mean expecting constant instability. It means recognizing that liquidity is not a fixed resource. It's dynamic, sensitive, and highly responsive to perception. It can expand quickly, but it can also contract just as fast, leaving those who assumed it was permanent suddenly facing a very different reality. And when that reality starts to shift, attention naturally turns to the safety nets people assume are always in place, the guarantees, the backstops, the idea that no matter how severe the stress becomes, there is an authority capable of stepping in and making everything whole. It's a comforting belief, reinforced by past interventions and official assurances, but it rests on a misunderstanding of how those guarantees actually function in practice. They are not limitless, and more importantly, they are not designed to cover you in the way most people imagine. On paper, deposit insurance appears straightforward. Up to a certain threshold, funds are protected, giving depositors confidence that even if a bank fails, their money will be returned. This creates a sense of security that feels absolute, as though risk has been removed entirely. But the key detail often overlooked is that these guarantees operate within defined boundaries, both in terms of coverage limits and the capacity of the institutions providing them. They are effective in isolated cases, when a single bank encounters trouble, but their strength is tested when stress becomes widespread, because the system was never built to handle everyone needing reassurance at the same time. Deposit insurance funds are finite, structured to address individual failures, not systemic ones. If multiple institutions face pressure simultaneously, the scale of required support increases dramatically. At that point, the burden shifts beyond the insurance mechanism and onto broader government resources or central bank intervention. And while those entities have significant power, they also operate under constraints, political, economic, and practical. This is where perception begins to diverge from reality. People assume that because governments can create money, they can solve any liquidity crisis instantly, and in a technical sense, they can inject funds into the system. But injecting liquidity is not the same as restoring confidence. If anything, aggressive intervention can sometimes signal the severity of the underlying problem, raising new questions even as it attempts to provide answers. The response itself becomes part of the narrative, influencing how participants interpret the situation. There's also the issue of timing. Guarantees are most effective when they are trusted before they are needed. Once doubt has already taken hold, simply announcing protection may not be enough to reverse behavior. Depositors don't analyze policy details in moments of uncertainty. They react to risk. If access to funds is even slightly threatened, the logical response is to act immediately, not wait for a process to unfold. This creates a gap between the intention of guarantees and their real-world impact under pressure. Another layer of complexity comes from the structure of modern banking itself. Large deposits, corporate accounts, and institutional funds often exceed insured limits by significant margins. These participants are fully aware of the boundaries of protection, which makes them more sensitive to early signs of stress. When they move quickly and in size, amplifying liquidity pressures across the system. Their actions can accelerate conditions to a point where guarantees are forced into the spotlight faster than intended. And even when support mechanisms are activated, they rarely operate in a way that feels immediate to the average person. There are processes, verifications, and timelines involved. Access to insured funds may be restored, but not necessarily in the exact form or speed that people expect. That distinction matters because during periods of uncertainty, time becomes a critical factor. Delays, even short ones, can reinforce the perception that control is slipping. What emerges from all of this is a more nuanced understanding of what protected really means. It doesn't mean immune to disruption. It doesn't mean instantly accessible under all conditions. It means there is a framework designed to mitigate loss, but that framework itself depends on stability, coordination, and confidence to function effectively. Remove or weaken any of those elements, and the guarantee begins to look less like a shield and more like a conditional promise tied to circumstances that may not always hold in moments of stress. And once those conditions begin to look uncertain, the distinction between small and large deposits stops being a technical detail and starts becoming a critical line of exposure. Because not all money inside the banking system is treated equally when pressure builds. The structure quietly favors stability at the lower end, where guarantees are clear and behavior is predictable, but becomes far more fragile as balances grow beyond those protected thresholds. That's where risk stops being theoretical and starts becoming highly situational. Large deposits carry a different kind of weight. They are not just numbers on a screen, they represent concentrated claims on liquidity that can move quickly and decisively. Unlike smaller accounts, which tend to remain relatively stable even during periods of uncertainty, large balances are actively managed. Corporations, institutions, and high net worth individuals monitor conditions closely, adjusting their positions at the first sign of instability. Their decisions are not emotional, they are strategic, and that makes their behavior both rational and potentially destabilizing at the same time. Because when these participants act, they do so with speed and scale. A single decision can trigger the movement of millions, sometimes billions, out of a single institution. And when multiple actors reach similar conclusions simultaneously, the effect compounds rapidly. What might have been manageable under normal conditions becomes a strain point almost instantly. Liquidity that appeared sufficient just hours earlier begins to thin out, and the system is forced to absorb shocks that were never meant to occur all at once. This is where the hidden risk of large deposits becomes clear. It's not just about exceeding insurance limits, although that's part of it. It's about sensitivity to perception. Larger balances are more reactive to changes in confidence because the potential downside is greater. When the margin of safety feels uncertain, the incentive to move first becomes overwhelming. Waiting introduces unnecessary exposure, while acting early preserves optionality. That logic is consistent, and when applied across the system, it creates a powerful current that can shift conditions very quickly. At the same time, banks are acutely aware of this dynamic. They understand that large deposits are both valuable and volatile. In stable periods, they provide a significant source of funding, allowing institutions to expand lending and investment activities. But under stress, they become one of the first pressure points. Managing this balance requires constant attention, and even then, it relies heavily on maintaining confidence. With it, confidence weakens, retaining those funds becomes increasingly difficult. There's also a structural mismatch at play. Much of the money deposited in banks is used to fund longer-term assets, loans, securities, and other investments that cannot be easily converted into cash without impact. This works as long as withdrawals remain within expected ranges. But when large deposits begin to move, the mismatch becomes more pronounced. Banks may be forced to sell assets quickly, often at unfavorable prices, to meet immediate demands. Those losses don't affect balance sheets, they influence perception, which in turn affects behavior, creating a feedback loop that's difficult to contain. What makes this even more complex is how invisible it remains during normal conditions. Large account holders may appear passive, their funds sitting quietly within the system, giving the impression of stability. But that stability is conditional. It depends on a continuous assessment of risk, one that can change rapidly as new information emerges. And because these participants have the tools and incentives to act quickly, their response time is measured in moments, not days. For the broader system, this creates an imbalance. Smaller depositors tend to react later, often after signals have already been set in motion by larger players. By the time concern reaches the wider public, a significant portion of liquidity may have already shifted. This sequencing matters because it shapes how stress unfolds. What looks sudden on the surface is often the result of earlier, less visible movements beneath it. Understanding this dynamic changes how safe is interpreted at higher levels of capital. It's not just about where money is stored, but how quickly it can become part of a larger movement. Large deposits are not inherently unsafe, but they exist in a more sensitive layer of the system, one where perception, timing, and scale interact in ways that can amplify even small changes into meaningful shifts in stability. And when those shifts begin to take shape, they rarely stay contained within a single institution or isolated corner of the system. What starts as a localized strain has a way of spreading, quietly at first, almost imperceptibly, before accelerating into something much broader. This is the nature of systemic stress. It doesn't announce itself with clarity in the early stages. It moves through connections, through shared exposures, through the subtle interdependence that defines modern finance. Banks don't operate in isolation. They are linked through lending markets, derivatives, shared assets, and counterparty relationships that form a dense and often opaque network. Under stable conditions, this interconnectedness is a strength. It allows capital to flow fitly, risk to be distributed, and opportunities to be expanded across institutions. But under pressure, those same connections become channel through which stress can travel. A problem in one area doesn't remain contained, it transmits. It often begins with something that appears manageable. A single institution faces losses, a segment of the market weakens, or a particular asset class comes under pressure. At first, the impact seems limited, but because other institutions hold similar assets or have exposure through financing arrangements, the effects begin to ripple outward. Balance sheets adjust, risk models tighten, and margins become thinner. None of this is dramatic in isolation, but together, it starts to shift the overall tone of the system. The transmission is rarely linear. It moves in uneven waves, sometimes pausing, sometimes accelerating, depending on how participants interpret what they're seeing. One institution's attempt to reduce risk can inadvertently increase pressure on another. Selling assets to raise liquidity can push prices lower, forcing others to mark down their holdings, even if they had no intention of selling. These adjustments feed into one another, creating a chain reaction that is difficult to trace in real time. What makes this particularly challenging is the lack of transparency. Much of the system's interconnected risk is not visible on the surface. It exists in off-balance sheet exposures, in complex financial instruments, and in relationships that only become relevant under stress. By the time these connections are fully recognized, the process is already unfolding. Participants are forced to react with incomplete information, which increases uncertainty and amplifies cautious behavior. And as caution spreads, so does contraction. Institutions begin to pull back simultaneously, not because they are coordinating, but because they are responding to similar signals. Lending tightens across the board, liquidity becomes more selective, and the system starts to shrink. This collective retrenchment reinforces the initial stress, turning what might have been a contained issue into something far more expansive. There's also a psychological component that accelerates the spread. Once the idea of instability enters the narrative, it changes how every piece of information is interpreted. Neutral developments begin to look negative, and negative developments take on greater significance. Confidence doesn't collapse all at once. It erodes through a series of reinterpretations, each one nudging behavior in a more defensive direction. This is why systemic stress often feels sudden, even though it builds gradually. The early stages are masked by normal activity, by the routine functioning of markets and institutions. But beneath that surface, adjustments are taking place, positions are being unwound, and risk is being reassessed. The system is, in effect, preparing for a different set of conditions, even if those conditions haven't fully materialized yet. When the shift finally becomes visible, it appears as though everything is happening at once. Markets move sharply, institutions announce measures, and participants react in unison. But that visible phase is the result of earlier, quieter developments that have reached a tipping point. The speed is not accidental. It's the outcome of accumulated pressure being released. And because the system is so tightly connected, stabilizing one area doesn't immediately stop the spread. Interventions may address specific points of weakness, but the underlying network still carries the imprint of stress. Confidence has to be rebuilt across multiple layers, and until it is, the potential for further transmission remains, moving through pathways that are only fully understood after they've already been activated. And as those pathways continue to carry stress through the system, the focus inevitably shifts to something far more immediate and personal, something that cuts through all the complexity and abstraction, the simple question of access. Not theoretical value, not long-term recovery, but whether money can actually be reached, moved, and used in the exact moment it's needed. Because in periods of instability, that distinction becomes everything. The number displayed in an account is, under normal conditions, treated as a certainty. It represents ownership, control, and availability all at once. But under stress, those elements begin to separate. Ownership may still exist on paper, but control can become conditional and availability can be delayed. This is where the true nature of financial security is tested, not in how much is held, but in how quickly and reliably it can be accessed when the system is under pressure. Access depends on layers that are usually invisible. Payment networks, clearing systems, internal bank processes, and external liquidity channels all have to function simultaneously for money to move without friction. When even one of these layers experiences strain, the effect can cascade. Transactions slow, limits are introduced, and what was once instantaneous becomes uncertain. It doesn't require a full breakdown to create disruption. Even minor constraints can change behavior quickly. Because once access feels restricted, even slightly, the response is immediate. People don't wait to see how conditions evolve. They act to secure what they can while they can. This reaction is not driven by panic as much as it is by logic. If there's a possibility that access could become more difficult later, the rational move is to prioritize it now. And when that logic spreads across a large number of participants, it creates exactly the kind of pressure the system struggles to absorb. This is where the difference between liquidity and accessibility becomes clear. Liquidity refers to the ability obligations to convert assets into cash to maintain flow within the system. Accessibility, on the other hand, is the user experience of that liquidity, the ability to withdraw, transfer, or spend funds without interruption. The two are closely related but not identical. A system can have underlying liquidity and still impose temporary barriers to access as it manages stress. Those barriers don't have to be extreme to be effective. Withdrawal limits, processing delays, additional verification steps, or temporary pauses in certain types of transactions can all be introduced as protective measures. From the system's perspective, these actions are meant to stabilize conditions, to slow the pace of outflows and restore balance. But from the individual's perspective, they represent a loss of immediacy, a shift from control to dependence on the system's timeline. What makes this dynamic particularly powerful is how quickly perception adjusts. The moment access is no longer seamless, confidence is affected. Even if the restrictions are minor or temporary, they signal that conditions are not normal. And that signal can influence behavior far beyond the initial point of friction. People begin to anticipate further limitations, and that anticipation drives additional action, reinforcing the very conditions the system is trying to manage. There's also an asymmetry in how access is experienced. Those who move early often encounter fewer obstacles, while those who wait may face increasing constraints as conditions evolve. This creates an incentive structure that favors speed over patience, further accelerating the pace at which funds are moved. The system, in turn, has to respond to that acceleration, often by tightening controls, which feeds back into the cycle. Digital infrastructure adds another layer to this equation. The ability to transfer funds instantly across institutions and borders compresses the timeline even further. What once unfolded over days can now happen in hours or minutes. This speed increases efficiency in stable periods, but during stress it amplifies reactions. Access is no longer just about whether money can be withdrawn, but how quickly it can leave one part of the system and concentrate in another. All of this leads to a redefinition of what safety actually means in practice. It's not just about the presence of funds or the strength of an institution. It's about the reliability of access under changing conditions, the consistency of the mechanisms that allow money to move when needed. Because when those mechanisms begin to shift, even slightly, the difference between having money and being able to use it becomes impossible to ignore.